especially since we have a small group, if you have any questions, if something doesn't make sense, if you see a typo, anything you want, this is your time, it's not my time, so stop me, interrupt me, do anything you want. Everything you're about to see is designed to show you that things aren't as they seem. There are things you can do that'll make your life better and easier. And I wanted to begin by showing you that there are a lot of things that we find in life that just aren't true. For example, the Battle of Bunker Hill in Boston was not fought on Bunker Hill, it was fought on Breed's Hill. Everybody calls it the Battle of Bunker Hill, but it was really Breed's Hill. Heinz 57, it says 57 varieties. There's only one variety. Heinz, his favorite number was 5, his wife's favorite number was 7. He saw number 57 on a billboard. He said, "That sounds good to me for my ketchup." So, good morning. Good morning. Are you here for the IRA presentation? Yes. Come on in and have some cookies, please. Just watch your step with the camera. It's recording, okay? And welcome. We're just getting started. WD-40. Does anyone know what the WD-40 stands for? It was the inventor's 40th try at a water displacement liquid. And finally, not finally, but one more after this, Stephen Foster wrote the state song of Florida. What is it? Swanee River, old folks at home. He wrote our state song, but has never seen the Swanee River and has never been to Florida. And finally, there's a song called Dueling Banjos, but it only has one banjo and a guitar. So there's the things in life that we take for granted that, oh, give me a home where the buffalo roam. In America, there are no buffalo and there are no antelope playing. There are bison and pronghorn, not the same. So the goal is to show you that there's things that they tell us and the things that we assume that just may not make as much sense as they seem to. And the goal is to give you some ideas and things you can do that will make your life better. And I want to emphasize to you, even though I'm with the foundation, I'm not going to talk about a donation to the foundation. I'm not going to talk about any products. Matter of fact, I'm going to show you things that we don't do that would be a great idea for you. Does that sound fair? So let's start at the beginning, some background. This is the United States tax code this year. The first thing I'll tell you is people say, well, I was going to get a raise, but it would hurt me because if I got the raise, it would increase my tax rate. Well, the reality is all of us, for the first $12,400 we make, are taxed at either at 10%. If we're married, well, if you're this amount, you're taxed at 10%. If you get another dollar over that, that $1 is taxed at 12%. So you're taxed based upon your earnings, but it's not, the taxing, or your raise does not increase your tax rate, just a little bit. So when they say, oh, I can't afford to get a raise because my taxes are going to go up, yeah, they're going to go up, but only for the part that's the raise, or the part above whatever section you're at. So probably most of the examples that I'm going to use are married filing jointly. It's just the most common, it's easy, but we'll look at it. The other thing is, the other tax we should all be concerned with are capital gains taxes. And for most of us, the tax rate is 15 or 20%. That's a tax you pay when you sell stock, and I'll show you an example of that in a minute. But these are the kinds of taxes that if we could reduce them, will make our life better. By the way, I'm not telling you to evade taxes, I'm telling you to avoid taxes. And everything I'm going to tell you are things the government has done to incentivize us to actually save taxes. So, here is the biggest problem I see, and the one thing that we can work on and build on from here. I want to introduce you to my son. He's a little bit older now, but that's my son when he was younger, and he's a good guy. He gives to the Salvation Army $3,000 a year. He gives to the Red Cross $10,000 a year. He gives to his alma mater $7,000 a year. He gives to his church $10,000 for a total of $30,000 a year. Fantastic. Up until 2017, it was a good formula. I give this to my church, I have mortgage interest, maybe some medical bills, and I can reduce my taxable income by that much money. So instead of being taxed on $100,000 income, I reduce it by 30 and I'm taxed on 70. That's a lower tax rate. Very good. In 2017, there was something called the Tax Cuts and Jobs Act, which aimed to reduce the number of people who itemize their taxes. The mortgage interest, the health care, and the charitable deductions. We're tired of seeing all the receipts, so let's do something about it, is what Congress said, which disincentivized people from itemizing their taxes. So as a result, the standard deduction is now higher, meaning if you're single, you can take a deduction of $15,750 whether you do anything, whether you have mortgage interest or if you live in an apartment with no mortgage, if you never give to charity, if you never have any health care, you can still deduct $16,000, almost $16,000 for doing nothing if you're single. If you're married, it's $31,500. So this guy who's been itemizing his taxes and doing a great job suddenly has no benefit in the tax code. But his brother, who doesn't give to charity, is fine with that because he gets a $31,500 deduction for doing nothing. Last year, we had another amendment to the tax code called the Big Beautiful Bill Act of 25. It said those lower tax rates that came around in 2017, we're going to keep them because they were set to sunset last year. So we're going to keep them. And we're going to continue having the higher standard deduction. So it's great, tax rates are lower, but we're going to take away your incentive to have a mortgage, give to charity, things like that. But it also added some new deductions like certain tips, like if you work for tips, it's a little bit better for you. Interest on car loans, things like that, but it's very limited and it's not very as broad as it could be. And they also said if you're going to give to charity, you have to give at least $1,000 for it to count for anything. By the way, am I going too fast or too slow? Doing all right? I'll try. Am I funny or not funny enough? I will try and increase the funny if I can, although with taxes it's kind of hard. So that's the background. By the way, I don't like questions at the end. You can come up and talk to me at the end, but please interrupt me if you have a question. Stop me. This is your time. It's not my time. Any questions so far, though, I want to ask? Okay. So the headline for today was IRAs. How to beat your IRA RMD. There's no one in here that has to worry about IRA RMDs. Everyone here is too young. But you should know this. When you reach a certain age, which this year is 73, and I'll tell you more about this in a minute, the government says you have to take money from your IRA. But I don't want to take money from my IRA. We don't care. You have to. About 6.5% of people in this country are required to make a withdrawal from their IRA and don't. Either through ignorance or laziness or whatever. They just don't take the withdrawal, even though the government requires them to do that. As a result, they pay tax penalties between $1,100 and $3,000 for not taking a required minimum distribution. That is a crime. I don't want to see anybody ever pay that penalty. You shouldn't have to pay it. I mean, it's right if you don't pay it. I mean, if you don't make the distribution, yes, you should pay the fine, but you should never be in a situation where you have to pay that fine. And there's about 8.5 million people in our country who are of the age that have to take that withdrawal, again, whether they want to or not. And the total penalties, the total fines added up for all the people who don't make that required minimum distribution, depending on their tax bracket, is anywhere from $678 to $1.5 billion a year. Again, the purpose of today is to educate people and show people you don't have to pay that penalty. Just make the withdrawal, if nothing else. I'm going to show you something better than the withdrawal, but make the withdrawal if you're 73 years old. Interestingly, people who don't make the withdrawal do it every year. They do it every year. They have a mentality of, I said it and forget it. I did it and I'm just going to keep moving. So I'm going to talk mostly today about charitable giving and charitable deductions because that's where you can make the biggest impact on your taxes. But it's not limited to that. But here's the basic idea. The government says you cannot give, that's me and my family a few days ago. The government says you can't give money to one of these three people, these three entities. You've got to pick two. Pick the right two. For me, it's charity and my family. It's not the federal government in Washington. I'd rather trust my family and charities to spend that money. Hey, Lee. I'd rather trust them to spend that money wisely and favorably. So, we've talked about the standard deduction, and I think it's a shame. My wife and I itemize. We give enough money to charity. We no longer have a mortgage, but we did last year. We had a mortgage and charity, so we itemized our taxes. And we got a nice deduction from our income, which made us pay less income tax because we lowered our income through charitable deductions and mortgage interest. I'm kind of hurt because now the standard deduction is so high, there's no incentive to do any of that. It didn't change our attitude, and we're still doing it, but it really stinks that my neighbor who doesn't do anything can get the same deduction that I get. But there is a way you can still make the standard deduction work for you if you are a charitable person. Here's how it works. And by the way, I'm going to show you, this is what my wife and I did, and I encourage you to try this if it's of interest to you. Something called a donor advised fund. My wife and I set one up this year, and we love it. It's a fantastic thing. Here's how it works. This is a donor. By the way, this is our donor, our taxpayer. And remember these rates from the other screen. She's married, so her standard deduction, if she does nothing else, she can get an income tax deduction of $31,500 for just breathing. She can reduce her income by $31,500 by just being alive, doing nothing else. But that's not her. That's not who she is. She is a very nice, kind person, and each year she gives $25,000 to her favorite causes. The Friends of the Library, the Mission here in Winter Haven, the American Red Cross, Mercy Hill Church, Salvation Army, and the Hospital Foundation here, where I'm part of. Very nice lady, gives $25,000 to each of these causes every year, but doesn't do her any good on her taxes because the standard deduction is $31,500. So what can she do? There's something you can do called a donor advice. By the way, bring my son back into this, my youngest son. He gives zero to charity, and as things stand, he gets a higher income tax deduction than the woman does. Because he gets a $31,500 income tax deduction, she gets a $25,000 income tax deduction, which doesn't reach the limit of the standard deduction. By the way, am I going too fast or too slow? Good. I'm not an accountant. I'll confess that. I'm an attorney, not an accountant. He gives zero to charity or anything else, but he gets that great standard deduction. So what can she do that would make her life better based on what she likes to do already? Well, what if, oh, by the way, here's her organizations again that she likes to give to. And she still wants to give $25,000 a year to each of those. There's an answer for her that will help her, that might help you if you're the right person in the right place. And it's called the Donor Advised Fund, which I've already mentioned to you. A donor advised fund is a charity owned by you. It's with a bank, financial institution, another charity. The one that my wife and I set up was with the National Philanthropic Trust, which is a charity. It cost us nothing to set up, zero. By the way, this is not a pitch for National Philanthropic Trust. I'm just using it as an example because that's the one my wife and I used. Fidelity, the investment company Fidelity, it runs the second or third largest charity in the country depending on the year because it has so much money in its donor advised funds, billions of dollars. So, using her as an example similar to my wife and me, she puts her $25,000 into the National Philanthropic Trust Donor Advised Fund, and she gets an income tax deduction when she does it of $25,000. which is pretty nice. Still not rising to the level of the standard deduction, but pretty nice. And then she calls the National Philanthropic Trust and says, I want you to send money to Mercy Hill, the Mission, all these other organizations, and they say, yes, ma'am, we'll do it. By the way, my wife and I, it's a blast. We have some friends who are missionaries in Africa, and we'll sit around at the dinner table and say, hey, let's send some money over to the missionary in Africa. And she has a website, she goes on, she says, send $100 to so-and-so in Zimbabwe. It's done. It's very easy. And it costs us nothing. And the best part is, when you have a donor-advised fund, the money in there grows. The money's being invested, and it grows. We were able to give donations to charity after 3 months that cost us nothing because the investments in it had grown, which is really cool. Just a neat thing you can do. But I still haven't solved the problem of how do you take advantage of this when she gives less than the standard deduction. Here's what you do. Again, if it's the right thing for the right person, instead of giving $25,000 a year to her donor-advised fund or her favorite charities, give $35,000 this year and nothing next year. She beats the standard deduction this year and then takes advantage of the standard deduction the following year. Does that make sense? An accountant would call this bundling. That's what they came up with in 2017 to beat the standard deduction. So now she'll give $35,000 to her donor-advised fund, and then she'll call up or go on the website and say, Philanthropic Trust, send a donation to Mercy Hill, or send a donation to the Red Cross. Or I don't like either of those, I'm not going to give anything this year. And then next year say, you know what, let the money grow, and then when it grows a little bit, give some to Mercy Hill. It gives her complete control over charitable giving, and she can time her deductions to make it work for her. Again, it costs nothing to set up. There's a zillion places you can do this. It's got to be the right thing for the right person. The neat thing is, too, in our will, we have said that 10% of our assets are going to go to our philanthropic trust, donor-advised fund, so our sons will inherit the ability to give charitably from our fund. So does this, sorry.
Yeah. Does it go like to local churches and stuff? Like, could you still give to your?
We made a gift this morning to our church. We got the tax ID number of our church. We asked the pastor for it. We called the Philanthropic Trust. They're going to mail a check to that P.O. box with the tax ID.
So you're using the Philanthropic Trust as just one. What's their reason to do it? Why are they?
They charge. They get 1% of the. They get some small percentage of the money that's in the account, but it's nothing.
But you're basically turning it over to them and saying, here, do this for me instead of me doing it.
Correct.
And it's costing you 1% to do that.
I think it's 1%. Yeah. It's negligible. Like, what's that?
I'm too tight.
No. I'm not even sure it's that much. I honestly don't know, because I can tell you this: it's grown more than whatever the charge is. So I'm happy with that.
Is it investment or is it just an interest investment?
No, it's investing in stocks, and it's like a regular investment account. Yeah, there are people with hundreds of millions of dollars in their charitable donor advised fund.
And that interest comes back to you.
No, it stays in the account, and you have to give it to charity.
But you have control.
You have control. There's one catch, and here's the catch. It's called a donor-advised fund, not a donor-controlled fund. Meaning, I can only advise the National Philanthropic Trust to make the gift. They technically don't have to follow my advice, but they always do. The only time, and I've done research on this, saying, well, why would they not follow my advice? It's generally when a charity is out of business or something's happened and they're gone and you've made a mistake, or you're trying to give to a friend, if it's not a charity, that kind of thing. By the way, I've always enjoyed looking at these because people have fun with it. People will call it the Frog Pond Fund or the Balloon Over Water Fund. My wife and I, her name is Heather Olson and I'm Wayne Olson, so ours is the WOHO Charitable Fund. I said, what should we call it? We're driving. I said, what should we call it? She said, well, she gave me 3 ideas. I said, that's the best. So anyway, that's donor advised funds. People don't know they exist. I want you to leave here today knowing they exist. And they are fantastic. And the beauty of it is, my wife and I only have one receipt this year. It's to that. So no matter how many, we give to 100 charities this year through that fund, we just have one receipt. It's to that. And when somebody gives a gift to the foundation here through their donor advised fund, we do not send them a receipt. We send the receipt to Bank of America. Because Bank of America is the one, they're not the one making the gift, but I receive my income tax deduction when I put my money in the fund, not when it's given out. Any questions? Yes, ma'am.
Wayne, did you tell us what the minimums are?
To start one, it depends on where you go. Some places it's $10,000, but most it's like $250, $500. It's very easy. Yeah, and there's and if you have any interest in this at all, call around or call me. I can give you some ideas. Again, I don't pitch any of them. I don't have any interest in any of them. I think they're good.
Lakeland, where I live, has the Give Well
Yeah.
Community Foundation. Does Winter Haven have a
GiveWell's here too.
Okay.
Yeah. GiveWell's a community foundation here in Winter Haven that offers the opportunity. I think they have extremely low entry rates and very low fees too.
Do they have the same people, like the same staff as Lakeland?
Yes, same thing, same people. Yep. Yeah, they have a branch office here.
I see.
Yeah. All right. Capital gains. If you have stock, this is for you. This is an article from the Wall Street Journal a few years ago, but it's still true today. 2/3 of people don't know they can give stock to charity. 2/3 of investors don't know they can give stock to charity. If you give money, if you own stock that's appreciated and you give cash to a charity, you're making a mistake. You always want to transfer stock to charity. Here's how it works. Let's say you have stock in the Big Thunder Mining Company at Walt Disney World, the gold mine at Walt Disney World. If I purchase that for $1 in 2004 and I sell it for $100 this year, I have a gain of $99, meaning I pay a $23 tax, meaning that even though the stock's worth $100, I only made $76 because I paid this much in tax. Don't pay a tax you don't need to pay. Instead, I'll use an example, I transferred that to my church or to the Red Cross or the Salvation Army or anybody. If I transfer it instead, and by the way, the key is to transfer it. If I sell my stock and take the cash and give it to charity, this does not work. I call my stockbroker, Fidelity, and I say, transfer 10 shares of Big Thunder to such and such, and this is how it works. I transfer my stock to the Red Cross. The Red Cross receives the stock worth $100. That's the current value of the stock. They sell it and get $100 to buy Band-Aids and blankets, which is fantastic for them. I receive an income tax deduction of $100 and pay no capital gains on that stock. I was going to give them $100 cash, but I gave the stock transfer instead. And what I'll do with $100 that I was going to give to them, I buy another share of this at a higher value, and I start with capital gains all over again, so I don't have the gain that I would have had. If you give any money to charity and you have stock that's appreciated in an investment account, stop giving cash and start transferring stock. You have a question?
On your last screen, it has 15% capital gains tax, so this one says 23.5.
Yeah.
Is there a standard?
Did I say 50%? Oh, 15. It depends on your tax. It depends on your income. Some people pay 15%, some pay 20, and some people pay 23.8.
What's that graph? Where do I find that?
Let's see. I thought I had it for you. Oh, I know where it is. I'll back up.
There it is.
It is, I'll go back. Excuse me. Right there.
So your capital gain is based on your tax bracket?
Yes. Yeah. If your income tax, if you're single and you only make $45,000 a year, the government says, we're not going to charge you any tax when you sell your stock. If you're single and you make $100,000 a year, the government's going to charge you 15% tax. And if you're single and you make over $545,000, they're going to charge you 20%. Plus, this is the Obamacare surcharge of 3.8% for certain taxpayers, high wealth taxpayers. But those are the rates. Does that answer your question? It used to be everybody paid 20%, and they lowered it to incentivize people of lower income to own and sell stock. I'm going to go through this quickly, but this is something that I can't even give you. I'd love to be able to do this, but we don't do it here at the foundation, and actually I don't know anybody in the Winter Haven does. But national charities do this, and this is a cool thing that just people don't know about. It's called a charitable gift annuity. The thing about a charitable gift annuity is it's a contract between you and a charity where it's not insurance. It's got the word annuity, so people think it's insurance. It's not. But it's where you give an asset to a charity, and then they pay you money back. My first day on the job, when I left the practice of law and I went to the American Cancer Society, my first day on the job, they handed me a stack of checks, and they said, I'm so glad you're here. You need to send these out to our donors. And I panicked because I thought donors gave us money. They said, and I didn't say that, of course, but I ran back in my office, I closed the door, and I quickly researched what these are. And it's where charities actually pay donors money. And it's legitimate, and the charity loves it, and the donors love it. So we have two donors. They each love the Red Cross. And they want to do something to help the Red Cross or the hospital. And they make a gift. The one on the left uses a gift annuity. The one on the right makes an outright gift. The one on the left is very happy, and so is the one on the right. Except after making the gift, he's expecting something back, and he has no clue. By the way, this is real life. This one always knows what's going on. This one could be hit. This one could be hit by a train and wonder what hit him. And by the way, I use my family because I don't have to pay royalties. And they consent. The thing is you can't change your mind once you do this. It's irrevocable, but here's how it works. The donor, you or me, gives charity an asset. I say gives an asset because it could be cash or it could be stock. The same benefits of transferring stock to make a gift work here too. I'll show you why and how. So, the charity will pay me a fixed rate for life. You said you like to save money? This is a way to get a fixed income for life. And here's how it works. After a lifetime of payments to me, anything left over goes to the hospital, the Red Cross, or whoever I did this with. And if you use stock, it's extra good. So if I do this, I get regular payments every 3 months for life, or monthly. You make a choice. I get an income tax deduction this year for part of the funding amount, and if I fund it with stock, there's capital gains benefits. The payments come to me as partially income, partially tax-free, and if I funded it with stock, partially as capital gains. You can be for one or two people. I could do a gift annuity to benefit me, or benefit my wife and me, or just my wife. Or you can do it for other people. I had a man come to me once 20 years ago, and he's at the University of Richmond, and he said, I've done really well. My aunt and uncle are poor. I want to fund a gift annuity for them, and I want you to deliver a check to them for $1,000 every month for as long as either one lives. How much money do I have to fund to get this? And I came up with a number, and I gave him the very first check, and he took it to his aunt and uncle, and he said, took him to lunch, and he said, here's a check from the university for $1,000. You're going to get one of these every month for as long as either one of you live. The donor was happy, the university was happy, the aunt and uncle were certainly happy. They had no idea it was coming. It was a great deal. Here are the rates. If you're 60 years old, the rate is 5.2%. If you're 69, it's 6.2. 98.5% of the charities in this country use these rates. Again, if you come to me and say, Wayne, I want to do one with the foundation, I will tell you, I can't do it with you. We're not equipped to do them here. But I do want you to leave here knowing this is something you can do if it interests you.
6.2% of what?
Of whatever you fund. If you give $100,000, you're going to get $6,200 every year for as long as you live.
On the total, 6.2 on the total.
Yes, sir. And it doesn't change. If the economy goes up or down, it's not any concern at all to you. The charity has said, we're going to pay you 6.2% of $100,000 every year for as long as you live. And if the charity blows the investment and that 100,000 goes down to 50, doesn't matter. You still get $6,200 every year. Now you have a choice. You can get that in a one annual payment or monthly or quarterly or semi-annually, but the amount never changes. The only thing that can happen is the charity goes out of business. That's why you have to pick the organization carefully.
So is it like a trust?
It's similar, yeah.
Does it have advantage of the trust?
Sir?
Does it have an advantage of the trust?
Yes, a trust costs money to set up, has to be valued and accounted for every year, and a tax return filed. This takes 5 minutes to do, and it's just a 2-page document between you and the charity. It's very simple, very easy. I love gift annuities. I've helped set up hundreds of these in my career, and it kills me that I can't offer them here. I'm working on it though. But you can see if you're, let's say you're 70, the average age of a gift annuity is 78. You give $100,000 or you give $10,000, you get $760 every year for as long as you live, no matter what the economy does. If you have a CD that you've been rolling over at the credit union for 10 years, hoping to get 4%, and I said, well, you know what? You can do this at 7.6% and get an income tax deduction for part of the funding amount, and it's part of it tax-free, and this is for as long as you live. That's pretty good. The catch is, and it goes back to what I said earlier, you can't change your mind. You'd never get the money back. And you can't leave it for your children. It goes to the charity.
Until you pass?
Until you pass. Yes, sir.
Because it's a gift.
It's a gift. Yeah. That's why you get the tax benefit, is because it's ultimately a gift. But the charity is going to bet that you live the life expectancy that you think you're going to live. But here's the cool thing, that I'm not kidding you. People who give money to charity live 2 years longer than the average person. And these rates take that into account. If you're 90, the rate is 10.1. 90 or above. I have done gift annuities for people that you can do as many as you want. I've done, I think 13 is my record with one person. Wrapping up here, getting to the headline of why we came here, I want you to make your IRA work for you. No one in here is old enough, but if you're 73 years old, the government says you've got to take money from your IRA. Here's the formula. Let's say your IRA has $500, you got to value your IRA as of December 31st in the last year. So I valued my IRA, it's worth $500,000. The government says, okay, Wayne, you're 75 years old, use a factor of 24.6, and the factor is 24.6, so take the prior year-end balance, 500,000, over that 24.6, and I have to take out $20,325 from my IRA, whether I want to or not. And by the way, the government says, here's how much you have to take out, and we'll be happy to collect your taxes when you do. That stinks. I'll tell you why. By the way, I use Rube Goldberg here as an example because this is complicated. I don't like complicated. This is as complicated as it's going to get today. So here's an example. This man has an IRA, and he has been, Congress set this up in the early 70s, incentivizing us to save money. And this man has an IRA, and he's very happy because he's been giving to it every paycheck for the last 40 years. He loves his IRA, and he's never touched it. He just keeps putting money into it, and he's done that for years and years. He's very happy about that. He doesn't even think about the day when he's going to have to take money out of it because he's so used to putting money in it. He is like you and me. But government says, he's very happy putting the money in, but the government says, hey, you had a birthday recently, you're 73. So it's time for you to start taking money out. And they say, by the way, when you do, we will be very happy to take a good portion of that. Thank you very much for having an IRA. Is there an alternative? Again, if you give any money to charity and you're over age 73, or if you know somebody over age 73, if they have an IRA, please stop them from giving cash to charities immediately. Because the government's going to require them to take money from their IRA, whether they want to or not. But the government says, we're going to give you an option. And this is an option that no one knows about. When I say no one, a very small percentage of people, because there's no one out there that's incentivized to tell you what I'm telling you today. If I'm Fidelity, I'm not going to tell you this. It just doesn't come up in conversation. So here's what can happen if you do this the right way. The government says, we're going to give you an option. Instead of taking that required minimum distribution yourself, you can give it to charity. And here's how it works. Instead of taking it himself, he calls Fidelity. It says, hey, instead of me taking $55,000 or $20,000 from my IRA this year, send it to the foundation instead. When I do, let's say it's the $20,000 I showed you a minute ago, I have satisfied the government's requirement that I take money from my IRA. Which means I can give the charity $20,000 and they get all of that $20,000 and I don't pay any income tax on it. If I were to take that money from the IRA, I'm going to pay income tax on it based on my income tax rate. This way, I'm doing something the government's requiring me to do anyway and not paying any tax on it. Please do not pay tax on your IRA if you don't have to. I was part of a lobbying effort, Lee, you probably were too, for years to get this passed into law. It was there for a year or two in 2005, then it was gone for a while, then it came back, then it was gone for a while, and it became permanent like in 2014. It's just a nice choice for you if you have an IRA. And there are trillions of dollars in this country held in IRAs. Here's an article from the Wall Street Journal, The Senior Secret to Deducting Donations. People just don't know they can do this. My goal today was to give you something you can do that you don't know you can do. I'll give you one last thing, actually two more things. Both are quick, but I'm going to show you some fancy things you can do if you involve charity in your planning. I told you before about a gift annuity where you get payments for life. You can use your IRA's required minimum distribution to fund a charitable gift annuity. But the government said, this is so good, you only can do it once in your lifetime. So you can only do this once. So make it good if you do it. And I'm serious. The government says you can only do it once. So if I want, let's say my IRA required minimum distribution is $120,000. My limit's only it's $110. I can only give $110 to charity. The other $10 I've got to pay tax on. For what I'm about to tell you, the limit's $55,000. Now you can do it for $5,000, but the limit's $55,000. What you can do is fund a charitable gift annuity with your IRA by transferring money from your IRA to a charity. And if she's 79, by the way, she is 79, incredible shape, her payment rate is 7.8%. And she puts $50,000 in the IRA, and she gets this much money every year for the rest of her life. The only catch is she does not get an income tax deduction this year because that money was never taxed. But she does get that much money every year if her age is 79, and that is taxed as income. But you're only paying income tax on $3,900. It's just a great way to use your IRA if you're over 73. And actually you can do it at age 70 and a half, but you have to at age 73.
That's 7.8 guaranteed.
Sir?
7.8 guaranteed.
Well, that as long as the charity is in existence, yes, sir. Yep. The only charities I know that have never met that obligation were charities that were set up to specifically defraud people. And for some reason, all of the fraudulent cases I know are in Arizona. I can't explain it. But if you go to the Red Cross, the American Cancer Society, your university, you're fine. When I was at the University of Richmond or the University of the South, we had hundreds of gift annuitants with millions and millions of dollars in the fund. And the fund always was we invested conservatively. There was always plenty of money. There was never a danger of it getting in any kind of trouble. Quick idea, people like to avoid probate. This is, again, something my wife and I did. If you have a checking account, savings account, investment account, 401k, IRA, 403b, there's something called a beneficiary designation. Use it. My checking account says that if anything happens to my wife and me, the money goes immediately to our two sons, 50% each. There's no probate, there's no anything. The Wells Fargo calls our sons, and says, hey guys, the checking account is now yours, fill out this paperwork, and we're getting started. So if you have any of those types of accounts, contact your bank or your financial institution and say, can you send me or tell me where I can find the beneficiary designation form, or POD as well, pay on death. We have one of these for every account we have. So you can do it. You can designate 10 people. You can designate 2 people and 2 charities. You can do whatever you want. The beauty is the funds goes to your family, your friends, whoever you want immediately when you die. There's no probate. When my father died last year, he divided it between most of his assets between my sister and me. I was the beneficiary of a POD, or a beneficiary designation. My sister was not. Her account was a regular investment account that said that he never did the form for. I think she's gotten her money, but it took a long time. She may not have. I got mine within a week. I'm not happy about that. I'd rather not have the money, but it shows you the difference between having this form and not. And the best part is, you can change your mind. You can change this form every day, or twice a day, or 10 times a day. It doesn't matter. As long as your bank's okay with it, you can change your mind. I'm going to close with something that, if you have a small business, this is just some fancy stuff for you. If you have a small business, show you the kind of neat things you can do. This is Sally. Sally owns a florist, and she's really good at growing and selling flowers. And her florist has done well this year. Actually, it's done really well. And Sally is the owner of the company, and she has 4 shares of stock in her company. She's the 100% owner of her company. She has 4 shares. Business is going well. But here's the thing. She doesn't have any money. All she has is ownership of the company. All the money is still with the florist. It's doing really well, but she doesn't pay herself, and the florist has just got a great bottom line. But she's a nice person, and she wants to give money to charity. What can she do? She doesn't have cash. She has $10,000 to her name, and that's if she sells her car. But she has a great business. So what can she do? This just shows you, if you have the right mindset, you can do great things that don't cost much money or any money and make great results for you. So she decides she wants to support her alma mater. And again, she doesn't have a lot of cash, but what she does, she says, you know what? I'm going to give you 1 share in my florist. Please, I'm going to give you a share of my stock. So she transfers ownership of the stock from her to the university. Doesn't cost anything, and now the university owns 25% of her florist. Can the university change the flowers that she sells or grows? No, they're a minority owner. They can't do anything. They really can't do much with the stock. But she's made a gift to the university. And by the way, the business has to be evaluated and appraised, and so does the share of the stock. But she still has given a share of stock to the university. What the university can then do is sell the stock to the florist. So the florist gives the university stock or cash and takes stock from the university, and now 75% of the shares are with her, 25% are with the florist. The florist owns 25% of itself, and the university has cash that she never had. Well, she's not happy with this because she wants to be 100% owner again, so she has a board meeting and says, let's dissolve the share that's owned by the florist, and now she's back to 100% ownership. She gave a cash gift to charity without ever touching or having any cash. Just some things you can do. Be careful. Ask questions when you write your will. This is a real will that came across my desk. This lady probably paid $10,000 or $15,000 for this will because it's a 30-page will with lots of intricate stuff. But she left money to organizations that don't exist. There is no National Heart Fund. There is no National Cancer Fund. There is no National MS Fund. And there's no National MD Fund. They just don't exist. Now, there is the American Heart Association. There is the American Cancer Society. But there are 6,000 organizations in the country that have cancer in the title that could all claim to be the National Cancer Fund. Just be careful. Make sure your wishes are followed for your family, your friends, anybody. Have a will. 2/3 of all adults in this country don't have a will. And it doesn't matter how wealthy you are. People, well, if I was rich, I'd certainly have a plan. No, actually not. Half of people with 10 million or more have no will. So just have a will, please. My wife and I updated our will last month, and it was just a great feeling. Everything I've told you today is things I've done, except for I have an IRA, but I'm not 73 yet. So that's it. Has this been helpful for you? Has it been interesting? Nothing to thank you. Nothing to sell, nothing to do, but I wanted to get you information. Does anybody have any questions?